Greetings, comrades. Let's start off with some key theory here. So our definition of accrued revenue is revenue earned yet to be received. This creates a current asset because that accrued revenue that we've earned represents an economic resource that will provide a future economic benefit to the business. So it satisfies the criteria for an asset, current asset, because we will receive those funds within 12 months. And so in order to satisfy the accrual basis assumption, which mandates that we recognise revenue when it's earned rather than received, we need to record a BDA, balance date adjustment. So let's work with this example here. So we've got 500k, we've invested into a term deposit, we're earning 6% per annum, and we're getting our interest in 2 half-year chunks, 1st of November and 1st of May. Now, if we look at the blue section here, where we need to record a balance day at the end of our reporting period, which is 30th of June. So we need to do a bit of maths here. So I'm going to go down to the yellow bit here, and let's just work out how much interest we have accrued. So we've deposited 500k, and we're going to multiply that by 6% to work out a full year's interest. So that's 0.06, careful with your decimals here. Then, to make this a bit easier for myself, I'm going to work out my interest per month. We're earning 30k per year in interest. So if we just divide that by 12, then we've worked out that we're getting 2.5k, or we're accruing 2.5k of interest per month. Now, we deposited the funds on the 1st of May, and our balance date is 30th of June, so therefore we're going to accrue 2 months' interest by balance day. So we just need to multiply our interest per month times 2, and that's how much we are accruing. So we're going to do a debit for 5,000, and we're going to do a credit for 5,000. So in terms of our accounts, let's just throw in the date here, we've created an asset account, accrued interest revenue. So I'll just type that in, which is increasing, so that's why it's a debit. And we've also earned some interest revenue, which would be reported in the other revenue section of your income statement. So then we post that information to our GL, our general ledger. So therefore we've done a credit entry to interest revenue. We're going to cross-reference that with accrued interest revenue of 5k, and we need a debit entry in our asset account, cross-reference with interest revenue. Now, we're getting to the second part. Then on the 1st of November, we receive our first instalment of the 6 months owing. And what we need to do here is we need to record the general journal entry to process that information, and then we're going to post it to our GL. Now, there's a couple of different ways we can approach this. I'm going to treat this as 2 separate entries because this asset account down here, accrued interest revenue, that is going to be cleared because we're going to actually receive that economic benefit. So it's a bit like when an account receivable pays you off. We do a credit entry to signify that that asset's being reduced. We're swapping one asset for another. So let's start with our GJ entry on the 1st of November. I'm going to record the fact that we have indeed received that 5k in accrued interest revenue. So we've got more money in the bank, cash at bank, 5,000 for the 2 months that we've received, and we need to clear off our accrued interest revenue account. Now, that's only for the 2 months that is owed. What about the other 4 months? Because for July, August, September, October, we have accrued that interest but we don't need to do a balance day adjustment. We're just going to record the fact that we have received that during the following reporting period. So we're just going to multiply that by those 4 months, and therefore we're going to receive 10K in interest. So again, a couple of different ways you can do this. I'm treating it as 2 separate transactions. So that money is being banked. So we're going to throw in another 10K into the bank. So we've got 15K in our bank there. I'll deal with the GL a bit later. And we've actually earned that other that 10K in interest revenue. So let's just tidy up our ledger here. So in our interest revenue account on the 1st of November, we've received and you close this off to the P&L summary when we get to the end of the reporting period, after we've done the next adjustment, when we get to 30th of June, so 10 grand there. I'm going to close off my account interest revenue because we've actually received that for 5K. And in our cash at bank, 1st of November, I'm going to double up here. So we've got the accrued interest revenue for 5K. And let's just create a bit of space here. And we've also got the interest revenue for 10K. That should be 5,000.